When preparing financial forecasts that support our corporate decisions, it's crucial that they are done in a credible and reliable way because these forecasts directly influence important investment choices for the organization. To ensure credibility, there are a few key points to focus on. First, the assumptions behind the forecasts must be clearly documented in separate sheets so everyone understands the basis of the projections. Second, the logic used in the forecasting process should be straightforward and easy to follow, meeting all the essential requirements for the decision at hand. And third, the forecasts need to comply fully with relevant taxation rules, accounting standards, legal agreements, and any preliminary documents involved. Typically, these forecasts are created in Excel as part of a financial model, using a method called Financial Modeling Best Practice, or FMBP. This approach provides a structured way to produce reliable and transparent financial forecasts, which helps build trust in the numbers and supports better decision-making. In the following slides, we'll go through the recommended steps to apply this best practice effectively. Financial Modeling Best Practice is a structured approach designed to manage the high risks involved in corporate finance projects, where millions of pounds and complex calculations are at stake. This approach isn't just for corporate finance, it should be applied to all financial modeling projects. While some may feel this method is too rigid, it's important to find a balance, especially since transactions often need to be completed within tight deadlines, which sometimes leads to models that aren't well designed. The process begins with the scoping stage, where we clearly define the model's purpose, in this case, preparing financial forecasts for an existing business over a 10-year period. The key outputs will include profit and loss, cash flow, and balance sheets, typically produced annually, and these outputs need to address the concerns of both equity providers and lenders. From there, the process follows steps including specifying requirements, designing the model structure, building calculations and formulas, documenting the model properly, testing it thoroughly, and finally using the model with version and change controls in place to ensure accuracy and reliability throughout its life cycle. This approach helps ensure that the financial forecasts we rely on are credible and robust. Sensitivities, or the ability to adjust the company's assumptions and see how that affects the base case results, should come from the company's risk assessment process. Key business and financial risks need to be clearly defined as sensitivity cases so their impact can be measured and addressed. The timeline for your corporate finance modeling project is critical depending on the scope and resources available. If you're working under tight deadlines, it might be best to keep your model's outputs to a minimum and bring in an experienced modeler who can finish the work efficiently. When we talk about functionality, we mean any special features in the model beyond basic calculations, such as optimization or advanced data table functions. During the specification stage, it's helpful to document the model's purpose, key outputs, major calculations, and assumptions. This helps keep the project focused. Although there are templates to guide this, it's important to tailor them to your needs. Moving to the design phase, Excel is almost always the best choice for corporate finance modeling, and typically, one workbook is sufficient. The structure and layout of the model are very important, and I recommend a modular approach where sheet names are clear and intuitive. From what I've seen, many modelers jump straight into building their models without following these earlier steps, which can make things harder later on. When working in Excel, it's important to keep inputs, calculations, and outputs clearly separated so the model reads logically from left to right. Where you must combine calculations with inputs, make sure to protect those cells properly. Use only one unique formula per row, copying the logic across columns to keep things consistent and easier to audit. Speaking of audits, place as many cross-checks as possible in the model to verify accuracy, things like balancing sheets, cash flows, net profits, and retained earnings. Lastly, try to keep formulas and labels as simple and clear as possible, though it's understood that financial models sometimes need complex formulas to maintain flexibility. Striking the right balance between simplicity and flexibility is key. Producing clear user and technical documentation, along with a data book, is essential and will be covered more thoroughly in the section on finalizing the model. Similarly, the testing and practical application of the model will be detailed in the dedicated testing section. To keep things organized, it's important to maintain both version and change control logs. For version control, each model file should include a sequential number at the end of its file name, like financialmodel1.xls, and whenever possible, record the differences between versions in a version control sheet as shown in the illustration. This helps track what's changed and who made those changes. Additionally, a change request log should be used to document any requested updates or outstanding work, including their current status to keep the process transparent and manageable. Both these logs are shown here as tables with columns for number, file name, date, details, and modeler's name, serving as practical tools to help ensure the model remains well documented and easy to follow throughout its development. To start building our financial model, we first need to clearly define its scope based on best practices discussed earlier. The model must integrate the latest historic balance sheet data with annual forecasts, projecting these on a yearly basis. It should include the calculation of key credit ratios for lenders and also determine internal rates of return for shareholder dividend streams. Compliance with UK GAAP and UK tax laws is essential, particularly for corporation tax purposes. Additionally, the model must be well structured and easy to update, allowing adjustments for future corporate finance transactions. To guide this, a specification template outlines the objective, intended users, output schedules, essential calculations, input data, required functionality, and appendices. The core objective is to generate a 10-year financial forecast, updated annually, that supports both shareholder and lender decision-making needs. The outputs we need to focus on include cash flow, profit and loss accounts, balance sheets, and key ratios, which cover both lenders' credit ratios and shareholders' equity internal rates of return. These outputs are detailed further in Appendix A. The model will be managed by the designated team, and it will also be shared with the relevant bank for their review. The output schedules required are specified in Appendix A as well. Key material calculations will cover new products and other significant areas, which will be defined as we progress. Input data will be derived from the model's outputs and calculations, with specifics to be confirmed. Regarding functionality, the model will include user menus for navigation, define sensitivity cases to test different scenarios, potential optimizations, and any other necessary features to support thorough analysis. Appendix A also provides example formats for cash flow and profit and loss account schedules to guide us in structuring these outputs effectively. Building on our previous discussions around financial modeling best practices, the next step is to design the corporate finance model itself. We'll create this model in Excel, using a single workbook that is organized modularly to break down the main components of the logic. We start by defining the structure of the model from the outputs and work backwards to the inputs, which helps us complete the underlying logic and gather the required data. The model follows a clear layout. Administration sheets come first, then yellow sheets for inputs, green sheets handle intermediate calculations, and blue sheets present the outputs. This color coding gives a visual progression from inputs to results, making it easier to navigate. Each sheet is designed with a specific purpose and clear, self-explanatory names, ensuring everything is logical and well organized. Inputs and calculations are placed where you'd expect, and by this stage, output schedules such as profit and loss, cash flow, balance sheet, summaries, sensitivities, and checks are already agreed upon with the client and included in the model. This layout approach is a standard I use consistently to ensure clarity and efficiency in all financial modeling projects. The model is organized into several worksheets, each serving a specific purpose. It starts with a cover sheet that includes the disclaimer, followed by version and change control logs to track updates. The general inputs and sensitivity inputs sheets allow for entering the base case data and testing different scenarios. There are dedicated sheets for sales, costs, and accounting details, as well as financing and working capital calculations. Taxation, shareholder returns, and lenders' ratios are also separately calculated. Multiple sheets hold sensitivity calculations to analyze how changes affect the model. The profit and loss, cash flow, and balance sheet forecasts extend over a 10-year period, providing a full financial view. A summary sheet consolidates the key outputs, while a sensitivities summary compares results against the base case. Finally, a checks sheet ensures all calculations align and cross-verify each other. To maintain the model's integrity, it's important to protect the workbook, allowing updates only in the yellow input cells, and safeguarding the worksheets and workbook from unwanted changes. This approach helps prevent errors or corruptions as you work through the model. There are several potential sources of errors to watch out for, which we will review in detail. A logic error usually happens when there is a mistake in a formula, like summing the wrong range of cells. Assumption or input errors occur when the inputs don't match the financial case, for example, using a discount rate of 10% instead of 12%. Documentation errors arise if the debt repayment profile doesn't align with what's outlined in the legal documents, while data book errors happen when the profile doesn't match the data book instructions. Taxation compliance issues come up if non-deductible expenses are incorrectly subtracted from taxable profit. Similarly, accounting compliance problems occur if an item is capitalized when it should have been written off immediately under the relevant standards, such as UK GAAP or IFRS. After the model is drafted, the builder should step back and conduct a thorough self-review. One essential method is top-level analytical reviewing, which looks at the overall picture to catch significant issues. This involves analyzing key ratios for the forecast period and checking how revenues, costs, and financing lines relate to the inputs. Correlating trade debtor and creditor assumptions, interest rates, and others with outputs helps spot inconsistencies. Graphing key areas supports trend evaluation and highlights irregularities like imbalanced balance sheets, cash flow mismatches, or negative debt balances. These checks help ensure the model's integrity before moving on to more detailed reviews. Now, we'll look at a specific example of how these analytical review techniques apply to our corporate finance model. The analytical review confirms that the balance sheet reconciles correctly, as does the cash position, with opening cash, cash generated during the year, and closing cash all aligning nicely with the balance sheet figures. Similarly, profit figures reconcile well, reflecting the opening profit, profits generated during the year, and closing balances. Sales growth, gross profit margin, EBITDA margin, EBIT margin, and tax to EBT all appear reasonable based on the assumptions we set earlier. The senior debt profile also reconciles accurately when considering opening debt, amounts drawn, repayments, and closing debt balances. For the shareholder loan profile, while it mostly reconciles, there's an unusual negative drawn amount. This is something we'll want to understand better and clarify as we proceed. Overall, the model's key financial elements are consistent and align with our expectations from the assumptions and financial statements. We created a detailed sheet called Analytical Review, Workings that tracks key calculations throughout the financial model's timeline. It includes 3 main checks to ensure internal consistency, specifically verifying that the balance sheet reconciles properly over the forecast period, and that the cash and profit movements align with cash generated and profit retained each year. The sales growth is calculated annually at 1%, matching the assumption built into the model. Similarly, the gross profit margin relative to sales stays consistent with those assumptions. Both EBITDA and EBIT margins appear stable and reasonable with no anomalies requiring further investigation. The tax amounts in the profit and loss statement align well with the expected annual tax rates, expense deductibility, and capital allowances, showing no issues. The balances for both senior debt and shareholder loans also make sense given the opening balances and adjustments for borrowings and repayments over the year, following a 5-year repayment schedule as outlined in the input sheets. Interest charges reflected in both the profit and loss and cash flow statements look appropriate, and when comparing interest to average debt balances, they remain close to the original assumed rates, which supports their reasonableness. Finally, working capital components like trade debtor days, trade creditor days, stock holding days, and other current asset days have all been back calculated and confirm that they are consistent with the original assumptions in the input schedules. Overall, these findings give us confidence that the model's financial mechanics are sound and reliable. The main issue we need to focus on is the shareholder loan amount, which currently shows as a negative drawing and requires further investigation and adjustment. Moving forward, we will examine a specific example of analytical review techniques by using graphing, which has been applied to our corporate finance model. Here, we analyze the dividends declared in the profit and loss statement and those paid out in the cash flow statement for each year. We have compared actual profits and the cash available for dividends with the payout ratio to ensure that distributable reserves and company cash levels are maintained appropriately. The graph clearly shows that dividends do not exceed the available cash, which is a good sign and doesn't raise any concerns. In reviewing key outputs like credit ratios and internal rates of return, it's essential to check for errors at this top-level summary since mistakes here can affect the whole model. We recommend reviewing the logic behind these outputs carefully. Flex and sensitivity testing are crucial techniques for identifying significant potential errors. Flex testing involves changing input values to see how outputs respond, focusing on areas with the highest risk. Sensitivity testing compares variations to a base case, allowing us to track and evaluate whether model changes behave as expected. Combining these tests with a thorough analytical review helps us rank and understand each result's importance based on our case knowledge, ensuring the model's reliability. The financial model you've built allows you to assess the company's position from all important perspectives. It shows how the company can deliver adequate returns to shareholders and meet its debt obligations, while also addressing any other key outputs. However, because these models rely on data from multiple sources, there can be errors, so it's important to include a disclaimer that limits liability. This usually states that the model has not been audited and recipients should do their own due diligence. It also clarifies that no guarantees are made about the accuracy of the assumptions or results, and that the preparer takes no responsibility for any errors or outcomes based on the model. Including this kind of disclaimer is a best practice before sharing the model with others.